Welcome. In this video, XEN may soon increase by 425%. So why? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. Fibonacci levels drawn from the bottom to the top are among the most commonly used tools in technical analysis to identify potential retracement or reversal zones for price. In particular, the 0.618 and 0.786 levels are considered very critical by investors, as the so-called golden ratio of 0.618 is highly respected, and the 0.786 level also acts as a very strong reversal zone. If the price completes its upward move from bottom to top and then begins to retrace, reaching the 0.786 Fibonacci level, this is often seen as one of the points where buyers step in. Selling pressure eases and the market may regain upward momentum. This is because the 0.786 level represents an area where, despite a deep correction, the uptrend is still intact. When a bounce starts from this level, it indicates that the market is being supported by strong hands and that a new upward wave may be in preparation. In such a scenario, one of the most important details investors pay attention to is whether the price truly gives a strong reaction from this level. If a bounce is started and strong bullish closes appear on the candles, this signals that buyers are taking control. Especially when this bounce is accompanied by increasing volume, it shows the reversal is genuine. The price turning upward from 0.786 is not just a technical coincidence, it also becomes a collective psychological support line, since many investors observe this zone. Traders enter positions with the idea that this level is now a buying opportunity, and thus the price begins to rise faster. The importance of the 0.786 level is also linked to Elliott wave theory. Often second wave corrections extend between 0.618 and 0.786. If the price has fallen to 0.786 and started bouncing from there, this could signal the beginning of a strong impulsive move like wave 3. Since the third wave is usually the longest and strongest wave, a reversal beginning at this level indicates significant medium to long-term upside potential. That's why many professional investors view the 0.786 level as a buy zone with a high probability of forming a bottom. At the same time, for a reversal from 0.786 to be more meaningful, the price needs to break through interim resistance levels on the way up. In other words, it's not enough just for the bounce to begin. The price must reclaim previously broken support levels. If this happens, investor confidence grows and the likelihood of the uptrend continues strengthens. Especially when the price reclaims the 0.618 level, it is interpreted as confirmation of the bullish trend. At that point, the price is expected to move toward the previous top and even surpass it to set new highs. A reversal from 0.786 is also very powerful psychologically. When the price falls this deep, many investors panic thinking the trend is over, the decline has begun. However, a strong rally from here can instantly break this pessimism and push investors back into buying mode. This psychological shift often causes the rally to be sharper and stronger. Thus, a bounce from 0.786 is not only critical from a technical standpoint, but also a turning point in market psychology. From a long-term perspective, the price bouncing from the 0.786 level shows that the trend is still healthy. Markets never move in straight lines, there are always waves and retracements. Deep retracement levels like 0.786 are actually areas where large players accumulate positions. While small investors panic sell, large players turn these sales into buying opportunities. That's why when the price reverses exactly from these levels, it often triggers a strong and sustained rally. This is especially true in cryptocurrency markets where volatility is high and price movements tend to deepen, often causing panic among investors. But those who view the market with a professional eye know that these panics are actually the setup for rallies. A reversal starting at 0.786 often results not only in recovery, but in surpassing the previous peak and heading toward new all-time highs. In conclusion, when price begins bouncing from the 0.786 Fibonacci level drawn from bottom to top, it is a very strong and positive technical signal. This is not just a minor rebound, but a sign that the trend has the potential to continue. Rallies that start from this level often bring significant long-term gains for investors, because by nature, the strongest rallies usually start from the points of greatest fear and panic selling. The 0.786 level is exactly where such panics peak, but also where big players step in. An upward move beginning here is often one of the signals of a strong trend being reborn. But we can't base our analysis solely on Fibonacci, so let's take a look at other metrics as well. Keep watching.
The formation of an uptrend in the RSI indicator is a highly valuable signal that shows the market is gaining strength, buyers are starting to gain more control over the price, and overall positive momentum is being built. The emergence of such a structure often suggests in technical analysis that there is a strong dynamic behind the price action. When this uptrend forms on the RSI, it is expected that the price will also move in parallel, creating a more stable and reliable outlook. At this point, the most important thing is that this uptrend must not be broken, because when the trend on the RSI is broken, momentum may begin to weaken, signaling that buyers are losing strength, and as a result, prices may start to move downward. RSI not only shows whether prices are in overbought or oversold zones at certain levels, but also how momentum progresses within trends. An uptrend structure has a much stronger meaning, especially on a momentum indicator like the RSI, because by its very nature, it is designed to measure the strength of price movements. If the RSI forms higher lows and higher highs, creating a trend, this indicates consistency and stability in the upward movements of the price. It is critical that this structure is not broken, because once a break occurs, market psychology can change suddenly, and the expectation of an uptrend may be replaced by uncertainty or even selling pressure. The preservation of an uptrend on the RSI creates a reassuring environment for investors. The indicator shows that the price has moved away from oversold zones, is trading at healthier levels, and that no weakness is being experienced during upward movements. For example, if the RSI consistently remains above 50 while forming an uptrend, this is a signal confirming that the general market trend is upward. It is crucial that this signal is not broken, meaning the RSI must not lose its uptrend, as this is vital for the continuation of the bullish scenario in the market. If the RSI breaks its uptrend, the rhythm of the market itself begins to change. At this stage, price movements may become uncertain, momentum may fade, and the market may become more exposed to selling pressure rather than buyer strength. On the other hand, maintaining the uptrend ensures that the bullish movement gains continuity and that the market continues on its path in a healthy manner. This is because the RSI trend acts as a kind of power source for the price trend. The upward movement seen on price charts can quickly weaken if it is not supported by the indicator. For this reason, the uptrend on the RSI must not only remain intact, but also grow stronger, supporting price action. Furthermore, the uptrend formed on the RSI is also a direct reflection of market psychology. The preservation of this trend keeps investors' confidence alive, reinforces belief in the market's upward direction, and creates strong buying motivation. If the RSI maintains its uptrend and each new low stays higher than the previous one, this shows that investors are not panic selling during pullbacks, but rather seeing them as buying opportunities. In such a case, prices can also be pushed to higher levels because the majority of market participants become willing to take positions in the upward direction. From a technical analysis perspective, the trend line on the RSI is at least as important as the trend line on the price chart. Just as it is important to follow the price trend, it is equally important to track the RSI trend. This is because a trend break on the RSI may be observed before prices change direction. If the uptrend is preserved, this is a strong indication that the price movement will continue upward. Therefore, the preservation of the uptrend on the RSI confirms that the bullish expectation for the price rests on a solid foundation. The uptrend on the RSI also shows the momentum of price movements. If the indicator consistently climbs to higher levels while forming higher lows during pullbacks, this indicates that the price is not merely in a random upward movement, but is instead moving upward with strong momentum. To prevent this momentum from fading, the RSI trend must be maintained. Once momentum is lost, price movements may flatten or even turn downward. This could invalidate bullish expectations and lead to breaks in investor psychology. Another important point is that when the uptrend on the RSI is not broken, it creates confidence zones for investors during possible corrections in the price. The RSI uptrend acts as support during corrections. If the RSI touches the uptrend line and bounces upward from there, this means a similar recovery can be expected in prices as well. Therefore, the RSI trend serves not only as a momentum indicator, but also as a safe zone for prices. For this reason, maintaining this trend is a very important technical condition for the continuation of the bullish movement. The fact that the RSI does not break its uptrend is also proof that buyers continue to maintain control in the market. Once this control is lost, sellers step in and the direction of the price may change. However, if the trend is preserved, buyers' will dominates the market, paving the way for the bullish movement to accelerate further. The preservation of the RSI trend means the presence of sustained momentum in the market. This continuity creates a positive outlook for both short-term and medium to long-term investors. The longer the uptrend is preserved on the RSI, the longer a price increase can be expected. In conclusion, the formation of an uptrend in the RSI indicator is a positive sign for the market, and the preservation of this trend is critical for the sustainability of the bullish movement. As long as the RSI trend is maintained, buyer strength continues, price movements remain stable, and bullish expectations stand strong. The breaking of this trend, however, can reverse the entire picture.
Therefore, the uptrend formed in the RSI indicator is one of the key elements that determines investor confidence, market health, and the future of prices, and it is a structure that must be preserved. The falling wedge pattern in technical analysis is known as a strong price structure, especially as a signal of a coming uptrend. This formation occurs when the price continuously makes lower highs and lower lows, compressing within a narrowing triangular structure. However, the most important factor to pay attention to during this compression process is that although the price appears to be trending downward, the trading volume gradually decreases. This decline in volume actually shows that the selling pressure in the market is weakening and that buyers are slowly starting to take control. In other words, although there seems to be a downtrend on the surface, there is a hidden preparation behind the scenes. That's why when the falling wedge formation breaks, it is often inevitable for the price to make a very strong upward move. At this point, the breakout of the upper line is a critical signal, because after the price breaks the upper trend line of the falling wedge formation upward, according to one of the generally accepted measures in technical analysis, it has the potential to move up by the height of the formation. In this case, if the measured target is reached, the price is expected to show a massive increase of around 425%. Such a large increase potential is not only one of the possibilities indicated by the technical structure, but also reveals the psychological side of the market, because the price, which has been squeezed within the falling wedge for a long time, creates impatience and uncertainty among investors. Many people exit the market during this consolidation phase, sell at a loss, or stay on the sidelines. However, when the real breakout occurs, when the upper trend line is broken upward, both a technical buy signal is formed and the buying pressure increases significantly with the desire of investors who exited early to re-enter the market. This creates a chain reaction and causes the price to rise sharply. Especially when it comes to a rate like 425%, this increase does not mean just a short-term reaction, but the beginning of a strong, long-term trend. Because the depth of the formation shows how much the market has been suppressed, and the movement after the breakout is expected to be a compensation for this pressure. The fact that the price rises by the height of the formation after such a pattern can actually be explained entirely by supply and demand dynamics. During the falling wedge, sellers continuously try to push the price down, but they gradually lose strength. Each new low is less severe than the previous one. This proves that the seller's power is weakening. On the other hand, buyers continuously accumulate at lower levels. When the upper trend line of the falling wedge formation is broken, there is no longer any barrier for these buyers to completely turn the game in their favor. When investors see the breakout, they buy. Short-term traders open long positions, and technical analysis followers calculate the target price and enlarge their positions. This chain reaction leads to a very rapid increase in price. The 425% target is not only theoretical, but also a scenario made possible by the combination of psychological pressure in the market and technical dynamics. In addition, another reason why the rise after the falling wedge formation can be so strong is that the price, which has been compressed for a long time, is like a spring being stretched. The more a spring is compressed, the stronger it jumps when released. The same logic applies here. Since the price has been under downward pressure in a narrow range for a long time, when the breakout occurs, this pressure reverses and buyers push the price upward. That is why the rise after the breakout can be surprisingly sharp for many investors. The 425% increase is precisely the result of this compression. Because the market relaxes as sellers are exhausted, while at the same time a surge of demand from buyers creates an explosion. In this case, the probability of the technical target being reached is quite high. Moreover, the upward movement that occurs after such a breakout generally goes through different phases. The first phase is the strong buying that comes at the moment of the breakout. At this point, strong candles above the upper line of the formation are seen in a short period. The second phase is when the price pulls back after the breakout to test. This phase is generally known as the retest. That is, the price touches the broken trend line again, and after showing that it has found support there, begins its real rise. The third phase is the accelerated upward period. At this stage, the price is expected to move toward the target with a 425% increase. Because confidence in the market increases, investors' appetite for buying peaks, and the rise turns into a self-sustaining cycle. A 425% rise not only has significant implications for the price, but also for investor psychology. A move of this scale shows that the market has completely entered bull mode, which means that the uptrend is dominant. People turn to even more aggressive buying in order not to miss the opportunity during such sharp rallies. This causes the price to rise even faster. At the same time, technical targets start being discussed in the media, on social platforms, and in investor groups. This visibility encourages more people to buy. In other words, the 425% price increase potential is not only a mathematical calculation, but also the result of a psychological domino effect. In conclusion, the falling wedge formation is one of the strongest bullish signals in technical analysis. The price breaking the upper line of this formation shows that the sellers have completely given up and the buyers have taken control. After the breakout, the price is expected to rise by the height of the formation, and in this case, a 425% increase potential emerges. This rise is not only a technical expectation, but is also supported by supply-demand balance in the market, investor psychology, and the energy created by the compression. Once such a move begins, it is often very likely for the target to be reached. Therefore, the upward breakout of the falling wedge formation should be considered a strong and reliable bullish signal that opens the door to a major opportunity in the market.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.